If I were starting over today, or if I were serious about positioning myself at the very top of the premium finance space in 2026, there are a few things I would do immediately. Not hypothetically, not eventually, immediately. Because premium finance is not going away, but the margin for error is shrinking. The advisors who dominate in 2026 won't be the loudest, they'll be the most disciplined. So let me walk you through exactly what I would do if domination, not survival, was the goal. First, I would narrow my market, not expand it. Most advisors think growth comes from adding more markets, more niches, more opportunities, more maybes. That approach dies in premium finance. In 2026, clarity beats volume every time. I would choose one very specific client profile: business owners, liquidity event clients, or ultra-high income earners with predictable cash flow. And I would study them obsessively. Not products, people, their tax pain, their liquidity fears, their decision timelines, their tolerance for leverage. Because premium finance doesn't sell itself, relevance does. Second, I would master tax-driven conversations. In 2026, taxes will be the fastest path to urgency. Not returns, not illustrations, not performance stories, taxes. High-income clients already know they're paying too much. What they don't know is what's actually actionable and what's noise. I would structure every first conversation around questions like, how much did you pay in income taxes last year? Was it more than 6 figures or less? What happens if that number stays the same for the next 5 years? Those questions create gravity, and gravity creates meetings. That's why premium finance works best when paired with real tax mitigation strategy, not product explanations. Third, I would stop pitching premium finance. This is critical. Premium finance is not a product, it's a capital strategy. Advisors who lead with, "Let me show you how premium finance works," lose authority instantly. Instead, I would frame conversations around capital efficiency, liquidity preservation, and opportunity cost. Then I would ask, how do you usually decide when to deploy your own capital versus using someone else's? That question reframes everything. Now you're not selling insurance, you're discussing capital allocation. Fourth, I would build fewer but stronger COI relationships. In 2026, premium finance will not tolerate weak COI alignment. You need CPAs who understand leverage, attorneys who understand structure, and advisors who can collaborate without ego. I would focus on deep relationships with a small group of elite COIs, not surface-level networking. Borrowed trust accelerates decisions, and premium finance lives or dies on trust. Fifth, I would operate like scrutiny is the default. This matters. As premium finance matures, scrutiny increases. Lenders will be more selective, carriers more conservative, regulatory expectations higher. Advisors who cut corners will disappear. Advisors who stress test designs, document conversations, set conservative expectations, and explain trade-offs clearly will win. In 2026, professionalism is the moat. Final NEPQ reframe. Here's the question every advisor should be asking themselves heading into 2026. Am I building a premium finance practice that relies on persuasion or one that relies on positioning? Because persuasion is fragile, positioning compounds. Positioning compounds. Bottom line, if I wanted to dominate premium finance in 2026, I wouldn't chase more deals. I would narrow my focus, lead with tax strategy, frame capital intelligently, align with elite COIs, and operate conservatively. That's how durable practices are built. And that philosophy is exactly what the JMac method is built around. Inside the JMac Method Academy, we train advisors to think strategically, position confidently, and operate at the level premium finance actually demands. Drop a comment and tell me which one of these would change your practice the fastest. That's where momentum really starts.